Picture the year 1998. The world is going absolutely mad for the internet. New companies are popping up overnight, and investors are aggressively throwing their money at anything with a .com in the name, terrified of missing out on the wealth of a lifetime. Then the year 2000 hits. The music stops. The Nasdaq plummets nearly 80%, wiping out half of those internet companies completely. Fast forward to today, and we are watching the exact same cycle play out, but this time it is fueled by artificial intelligence. Every financial feed is telling you to buy into AI right now to secure your future. You are caught in a trap. You feel the immense pressure to pour your savings into these tech giants to catch the wave, but you are standing on the edge of a trillion-dollar market collapse. Deciding how to invest your money today requires looking past the hype. You have to make a choice between chasing peak tech gains or proactively protecting your wealth from a catastrophic year 2000-style wipeout. The trap usually starts in what you think is your safest account. Standard passive index funds like the S&P 500 are currently operating as disguised, high-risk tech speculations. This animated pie chart breaks down the S&P 500 to show how market cap weighting actually works. Because the biggest companies swallow the most capital, 40 cents of every single dollar you invest into the broader market is absorbed by just 10 tech giants. And within that concentrated slice, Nvidia alone commands up to 8 cents of every dollar you contribute. These few giants are spending roughly $330 billion in a single year just to build their AI infrastructure. To mathematically justify those valuations, they would eventually need to make around $2 trillion in actual revenue. When you look at the math, true diversification in a standard index fund is an illusion right now. As an average investor, you are unknowingly holding a highly concentrated single-sector tech bomb. Because these companies aren't generating $2 trillion in profit yet, their stock prices are being artificially inflated by a mechanism Wall Street calls the AI money machine. This flowchart tracks the circular flow of cash keeping the bubble inflated. Microsoft hands massive funding to OpenAI, who pays Microsoft to use their servers. Microsoft takes that money to buy NVIDIA chips. NVIDIA then invests capital back into OpenAI. Every single time that exact same money moves through the loop, these companies record it as fresh revenue, which pushes their stock prices endlessly higher. It is the equivalent of two people paying each other $1,000 to dig and fill the exact same hole in the ground and then claiming they have a booming business. This financial illusion is on a collision course with a physical limitation called the data wall. AI models train by devouring the internet, and researchers project they will completely exhaust all human-generated online content by 2027. When that progress stalls out because there is nothing left to read, the hype will evaporate. And when it does, the Magnificent Seven will drag the rest of the US stock market down with them. To protect yourself, you need to systematically move your capital out of the crowded, hype-driven zone of mega-cap tech. This graph maps out exactly where the smart money is going. We are focusing down here on small and mid-cap companies. Instead of spending billions trying to build base models from scratch, they are simply buying existing AI tools on the cheap to solve practical business problems.
Beyond the size of companies, you have to address geographic concentration. The U.S. market has dominated global returns for the last 14 years, but historical market cycles prove that no single country stays on top indefinitely. You offset this risk by utilizing global index funds like VWRP or FSPSX. A single fund like this spreads your wealth across 4,000 companies in over 45 countries, capturing the massive global growth happening entirely outside the American tech bubble. Now, let's be clear about the trade-off. Global funds and small-cap stocks will underperform the U.S. market while the AI bull run is still raging, but they provide the structural and geographic insulation you need to survive a localized tech crash. The second half of your lifeboat strategy requires building a strategic reserve, using cash and gold as your ultimate defense against market instability. Look at Warren Buffett. His conglomerate is currently sitting on over $340 billion in pure cash, specifically waiting for overvalued assets to go on a massive discount. At the same time, global central banks are accumulating gold at record levels. They now classify gold as a Tier 1 asset, treating it exactly like cash because it offers unparalleled hedging against a financial crisis.
The immediate downside to this is obvious. Holding cash yields very little return, and it actively suffers from the drag of inflation while the market keeps going up. Sacrificing minor immediate gains to hold dry powder is a calculated trade-off. It guarantees you will have the liquidity to swoop in and buy high-value assets at a severe discount when the bubble finally bursts. This brings us to a crucial step. I want you to perform a 30-second risk audit on your own accounts today. Open your primary investing app and check your exact exposure. Look specifically at what percentage of your portfolio is tied up in the Magnificent 7 tech stocks. Next, check your ratio of U.S. equities compared to your international holdings and verify exactly how much you have sitting in a defensive cash reserve. Realizing your supposedly safe retirement portfolio is dangerously top-heavy can be incredibly uncomfortable, but identifying that hidden risk today is the only way to avoid the fate of those investors who were wiped out in 2000. How you fix this depends entirely on your risk profile. If you are an aggressive speculator with a very long time horizon, you can afford to stay heavy in tech, but you must emotionally accept the trade-off of a potential 50% drawdown. If you are a prudent optimizer building long-term wealth in the middle road, you need to implement the lifeboat strategy. You accept slightly lower peak gains by mixing in global funds to protect your principal. If you are a preservationist nearing retirement, you must aggressively prioritize cash and gold reserves. Eliminating the risk of retiring straight into a tech crater is absolutely worth missing the final 10% of the hype cycle. To see exactly how to automatically funnel your next paycheck directly into these safe haven accounts, check out the follow-up video on your screen right now. Surviving a financial bubble doesn't require perfectly timing the market top. It simply requires structurally removing your wealth from the blast radius, protecting your future long before the alarm even sounds.